Today, put interest rates up and reform taxes now. Hello again, it's Martin North from Digital Finance Analytics. Well, latest post covering finance and property news. Well, the IMF just dropped a bombshell on Australia, saying that interest rates should be hiked even higher and that the Australian government should slash spending to avoid stoking inflation. And they said that proper tax reform was essential, as an optimal tax package for growth and equity should rely more on the GST, take pressure off personal income tax paid by workers, and crack down on capital gains tax breaks. Now, let me say, the IMF has a particular free market neoliberal Western economic spin, but their comments, well, are pretty damning and need to be taken seriously. And yet, of course, the Australian politicians were quick to claim the IMF somehow endorsed their current policy settings. What? Read the report, Albo. Each year, the IMF holds bilateral discussions with members, including Australia. A staff team visits the country, collects economic and financial information, and discusses with officials the country's economic developments and policies. Then they return home, and the staff prepares a report, which forms the basis for discussion by the executive board. And on Friday, we got their bombshell recommendations for Australia. The findings followed a 2-week mission by IMF officials that met the RBA, Treasury, businesses, and economists in late November and early December. Their top-line observation was that interest rates should be hiked even higher and that the Australian government should slash spending to avoid stoking inflation. And while the annual Australian Economic Health Check said Australia was likely to avoid a recession, it recommended that monetary policy should be tightened further to ensure inflation comes back to target earlier than 2026. That's slightly later than the central bank's late 2025 timeline. As a result of the RBA's rate hikes, which started in May 2022, lifting rates, of course, to their current 12-year high of 4.35% to tackle inflation, the Washington-based institutions warned that household borrowers were bearing the brunt of higher rates amid lower real wages and depleted savings. No news there. The IMF forecasts the RBA cash rate will average 4.4% this year and 4% in 2025, implying very limited relief from the current 4.35% cash rate. Higher policy rates have primarily affected lower income households, with mortgages adding to their hardship amid high inflation and cost of living crisis, they said. But cutting interest rates too early risked interest rates remaining high for longer, which would trigger pockets of household distress, it said. In effect, the fund pushed back against financial markets' bets for rate cuts later this year, arguing there was no scope for a cut in the cash rate in the near term due to strong inflation in services, a low 3.9% jobless rate, and wages pressure. The hawkish call is despite the estimated depletion of up to $280 billion of excess savings built during the pandemic, which the IMF said could sharpen the impact of rate rises as households run out of their financial buffers. Respite for households in the form of lower interest rates, therefore, was unlikely anytime soon due to broad-based inflation in the labour-intensive services sectors. This is, of course, the problem. Much of the inflation surge is now homegrown, and this echoes warnings from the RBA Governor Michelle Bullock that Australia's inflation pressures were now homegrown, and the IMF said there was no scope to cut the cash rate in the near term, dashing market expectations of 2 rate cuts this year. The fund actually praised the Albanese government's decision to return soaring tax collections to the budget bottom line, which was helping to ease inflation, but said that state and federal spending needed to be cut to avoid adding to price growth and the resulting mortgage pain for household borrowers. A tighter fiscal policy is needed to support disinflation. Fiscal policy must strike an appropriate balance between supporting monetary policy by not adding to inflation pressures in the near term, it said. And the report also called for comprehensive reform of the tax system by reducing Australia's personal income tax burden and for the Albanese government to play a coordinating role to ensure billions of dollars of infrastructure spending didn't contribute to inflationary pressures. And the IMF also took aim at the blisteringly high pace of overseas migration, which they say has contributed to a chronic shortage of rental properties. Rents have also increased at a very fast pace, with strong growth in immigration following the post-COVID reopening, adding to pressures given housing shortages. And the IMF expects the Australian economy to expand by just 1.4% this year, up from its previous October forecast of 1.2%, by the way. The estimate is more pessimistic than the RBA's economic expectations, is that the Australian GDP will expand at 1.75% in 2024. Australia's tight jobs market will gradually loosen the IMF forecasts, with the jobless rate set to climb to 4.8%, up from its current level of 3.9%. And at the same time, headline inflation is expected to continue to moderate, reaching the RBA's 2 to 3% target band by 2026. In 2024, consumer prices will average 4%, which is roughly in line with the RBA's official forecasts. And echoing warnings from the RBA's Governor Bullock that Australia's inflationary pressures were being driven by homegrown stuff, the report warned that sticky prices in the labour-intensive services sectors would fuel future price growth. While external price pressures have abated, leading to an easing in goods inflation, persistence in non-tradable prices driven by demand pressures will keep inflation elevated, the IMF said. Well, no surprise, but Treasurer Jim Chalmers claimed that the IMF's report was an endorsement of the government's economic credentials. There is no shortage of challenges in the economy, Dr. Chalmers said, adding that a combination of inflation, higher interest rates, natural disasters, and global uncertainty were weighing on GDP growth. But this report confirms Australia comes at these from a position of genuine economic strength. On the other side of politics, Shadow Treasurer Angus Taylor said the report underscored the financial hardship that Australian households were continuing to suffer. Most damning, he said, the IMF has called out Labor's weak budget management and migration policies as making inflation worse, Mr. Taylor claimed. But if you stand back, there are some really important questions, particularly as the Stage 3 tax cuts have been confirmed as coming in later in the year. There is a really important question as to whether, in fact, the current government is actually doing sufficient in the right areas to set Australia up for growth down the track. I don't think they are. And in fact, they are relying on levers which we know are not very effective. So this is a very important wake-up call for politicians in Australia. But of course, they're going to look the other way and magically claim there's nothing to see here. Well, I think there is. Worth taking on board some of these recommendations, especially noting that rates are not coming down anytime soon. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.